started getting a handle on technical analysis and technical indicators. Now, in tonight's class, I'm going to share with you a couple pre-prepared presentations. If you'd like to see these separate prepared little presentations that are a minute or two long, you can see them by going to YouTube and looking for the channel on YouTube that's called Trading Education, and then look under the playlist for technical analysis, and you'll find these little presentations on technical indicators. Now, also, if you look on your screen, you'll see that I put together some handouts for you. These handouts are downloadable only during the live class. You will not have access to them in the recorded version. You won't have access to them to when the webinar is over this evening. So please download them to whatever device you're using, and then you can move them around at your convenience. Now, what I've given you there is a guide I put together for you, which is the introduction to or technical indicators guide. Is the top technical indicators, and they're all explained and shown step by step. I've given you also the Introduction to Technical Analysis ebook from investing.com. Now, this is not a little marketing ebook. This is a reference piece of material. This is a quite extensive ebook on all the aspects of technical analysis. And then I've also given you the ebook on technical indicators that has been put together by investing.com. And lastly, I gave you a little page and it has a link to the YouTube channel if you want to see these small little presentations. So please click on that download button. There's nothing you have to sign up for, nothing you have to roll in, nothing you have to put your name in. Just click the download button. It'll be downloaded right to your whatever device you're using, and that's the end of it. Now, also in tonight's class, I'm going to intermix the term security, asset. I might say Google, I might say Facebook, I might say the euro, I might say the pound, I might say Bitcoin, but I'm not referring to any really specific asset. It just gets very boring saying security, security, security over and over again. Okay. Because what we're going to learn tonight and what we're going to be looking at are technical indicators, and these technical indicators will apply to any and all assets that are traded in the financial instruments that are publicly traded in the open market. Similarly, I'm also going to intermix the terms investing and trading. Now, to be honest with you, we know the difference, and we're all here because Alvexa is our sponsor, and Alvexa only offers CFD trading, so that's for traders, and you are traders. We know the difference with investors. Investing is a long-term proposition, and you also can be investors. You can have investments in your retirement account. You can have all types of other types of stocks and bonds and whatever you're buying, but you're not trading them, you're investing in them. But an investor very rarely looks at any technical analysis because they're looking for where the asset or the security or Google will be trading down the road in a longer term aspect. They're not concerned with some indicator that says say buy now, sell now. But again, these concepts we're going to talk about tonight are equally adept. Now, the question everybody asks me whenever I give a seminar, especially a live seminar, the main question I get asked when I'm talking to people after the seminar, even before, is what should I buy today? Maybe I should sell today. What will the prices be an hour from now, later today, tomorrow morning? So wouldn't investing and trading be easy if we had the answers to these simple questions? But see, I don't have a Ouija board. I don't have a crystal ball. Nobody, but nobody can predict where an asset will be later today or tomorrow or in this afternoon. What we use are a combination of strategies to find opportunities to trade and combine that with exceptional risk management and money management skills. Now, if you think technical analysis is going to give you this edge to give you all of these miracle trades, it's not going to happen. But if you're attending this webinar with hopes of technical analysis, especially in technical indicators, will improve your trading and investing, I got good news for you. It surely will. Now, if you think about trading, what we're really doing when you break it down is, as traders, especially our class of traders, retail traders, we're not talking about hedge funds. We're not talking about central bank traders. We're not talking about guys that are trading millions of dollars at a time. We're talking about us. And us, we are looking for only a few trades that have the highest probability of being successful. So what we want to do is offer or put together a strategy or a philosophy of filters. And if you think of all the things that we use as filters, and what they're doing is, the first thing you have is something that's going to generate signals, buy or sell alerts, transactional indicators. Something's going to tell you there's an opportunity brewing. Okay. From there, and that's whether you get signals pushed out to you, whether you use some advisor, whatever you're doing, however you're getting it, whether you're using a MACD crossover, whether you're using a break above support, whatever you're using something to tell you that a potential opportunity is presenting itself. Let's put it plain and simple. That's the best way I can explain it. Now, from there, we want to start filtering out this opportunity to see if it's any good for us. And we want to apply layers of filters. At each one of these filters, if that trade or that opportunity is supported by each filter, you look at the next filter, because you're hoping that one of the filters you're using, whether it's a trend pattern, whether it's a break above support, a fall below resistance, whether it's a break of a trend line, whether it's a double bottom, whether whatever it is you're using, whether it's MACD or RSI breaking 80, whatever you're using. Now what you want to do is filter down that trade and put it through these different filters to see if that's still a viable trade. Will whatever combination of trend lines, support and resistance lines, chart patterns, trading indicators hold true? Okay. Now, if it does do that, then we have to start getting really serious, because now we have to decide what our risk management will be, where we expect the asset will go to if we make this trade, how many pips we could make, what the volatility is in the market, where we would have to put our swing or our stop loss based on the current market conditions, and then apply our money management and risk management skills, all again filtering it down, because see, if it doesn't fit our risk management strategies, we can't make that trade anyway. If it doesn't fit our money management strategy, we can't make that trade no matter how good the opportunities that presented itself. Each one of these filters takes it away from being a trade. And what you want to do is only end up with a trade that flows through all of these layers. So traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. Well, it's not that price never lies. Price is what controls the market. No matter what you want to do, no matter what somebody tells you, no matter what some algorithm generates, the only thing that controls the market is the price. Now, if we believe, and it's kind of my philosophy, many people explain it in different ways. I call it the randomness of the markets. If we believe that price controls everything, and price is a psychological reflection of all the buyers and sellers out there, and that price is unpredictable, price is random, absolutely random, that tells us that we can never trade without just being guessers. But if we believe that in this randomness, we get certain periods of time or certain fluctuations that give us these non-random movement. And during these non-random movement times of movement, we can then apply lots of indicators, oscillators, technical analysis to the market and get a solid trading decision. Now, these non-random periods of movement are actually what? They're trends, uptrends and downtrends. Now, if we remember the explanation of an uptrend or downtrend, an uptrend is a price is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Okay. And a downtrend is just the opposite. But what is this? When this is actually happening is non-random movement. Now, we can have price moving up. But what do we have there? We have random movement. When price is in a real trend, an honest to God real trend, you have non-random movement. When it's following the rule of a trend, you have non-random movement. And we can then start applying indicators, oscillators, and other strategies to make smart trades. So when we start putting all this, now, everything and anything we do on a chart falls in the field of technical analysis. And one of these fields, or one of the sectors of technical analysis, is called technical indicators. Although to a lot of us, especially to newbie traders, they think RSI, Stochastics, MACD, CCI, Williams %R, all of this makes up all of technical analysis. But it isn't. It's a small little sector of a very large field. But it's, again, anything and everything we do on a chart, from looking at a chart to having a line chart to having a bar chart to having a candlestick chart, reading candlestick, is all technical analysis. But the field of indicators and oscillators are mathematical calculations. Now, the main similarity between technical indicators is that, first of all, they all use, so the main similarities, they all use the same numbers. Because the only thing that we can base these mathematical calculations on is the open, the high, the low, and the close in volume. From these numbers, they have varying mathematical or statistical formulas that are applied to them. So this small number of variables has produced hundreds and even thousands of indicators. So let's jump over to a chart here for a second. So we have technical indicators are usually found below the price chart. And most of these that are below the price chart are oscillators. Because we also have things, simple things, indicators like moving averages. Moving averages are placed directly on the price chart. And moving averages are a simple technical indicator, because anything that's using a mathematical calculation and using the price and then applying some calculation to it is an indicator. We also can go to Bollinger Bands, which is a trading envelope, which is dropped directly over price. And then we have some of the more popular ones like RSI and Stochastics. You have MACD on the chart now below, but we'll drop RSI on there. Relative Strength Index. And that goes below. And an RSI is a technical indicator that falls in the category called oscillator that goes one step farther, that becomes a bounded oscillator. But all of these are mathematical calculations. So we start out with a simple moving average, and a simple moving average is just, if we're using a 20-period moving average, we take the last 20 closes, whatever time frame we're looking at, add them together and divide it by 20. That's really pretty simple. But that's a technical indicator. Then we can take MACD, which is based on a derivative of a derivative of a derivative of a derivative. Or we can take Bollinger Bands, which we have on our chart right now, and Bollinger Bands uses a statistical calculation called standard deviation, which wasn't developed for the financial market. It is a well-known, used statistical calculation that adds together the mean or the average, and then is a square root of the actual deviation of the average from the deviation of the price from its average. So it's a quite complicated mathematical formula that's based on the moving average, which is based on the price on the chart. So these are the different types of technical indicators. But from here, we go on to breaking them down into categories. So a technical indicator is a mathematical calculation that can be applied to an asset's past patterns like price, volume, or even another technical indicator. Technical indicators do not analyze any part of fundamental business. It doesn't look at news or headlines. It doesn't look at economic results. It doesn't look at quarterly earnings. It doesn't look at profit margins. Could care less. Technical indicators are based on mathematical calculations and the philosophy that everything and anything that could happen that would affect the price is already calculated into the price. So as a result, technical indicators are used for three things: to alert the trader about a trend, to predict the direction of future prices, and confirm other types of indicators. They can confirm a breakout of a chart pattern. They can confirm a bearish or bullish engulfing pattern in a candlestick chart. Now, technical indicators fall into two categories: what we call leading and lagging. Okay. Now, to most of us, leading is a good thing and lagging is a bad thing. Like if a teacher, principal calls you and tells you, well, you know, your kid's leading the class, you're a proud parent. If they tell you they're lagging behind the class, you're a little, okay, what can I do to help them out? In the area of technical indicators, leading and lagging are not good and bad. They're not defined as good and bad. Because leading indicators are those that lead price movement. They give a signal before a new trend or a reversal occurs. Lagging indicators are those who follow price action, and they give a signal after the trend or reversal. So it confirms price action. Now, indicators, all the indicators out there, and you've probably heard of a handful, but there's actually hundreds and hundreds of them, and there's more being developed every day. But most of us use a standard variety of them because they've been tested in the markets. There's lots of literature about them. We can learn about them, and these are the ones we apply. But you could develop your own technical indicator. It could be yours. Now, all indicators fall into the category. They're either trend indicators, momentum indicators, volatility indicators, or volume indicators. Now, so many indicators give us or offer us several different types of stories that we can get a momentum and volatility and volume within one indicator. Like MACD offers three completely different stories for us. So they give us three parts of the market, which is great because then we can use one indicator to get three answers. So before we go on here, I'm going to share with you a little presentation that will hopefully demonstrate this or explain it in a little bit better visual format. And then we're going to talk about the different types of indicators and what, which falls into what, and what's leading and what's lagging indicators.
Careful and effective use of technical indicators can improve your odds of finding an investment's best entry and exit points. Technical indicators are calculations based on a trading instrument's past, price, and volume activity. They help technical analysts to predict an investment's future price. Some better-known indicators interpret trend, momentum, volatility, and volume. Multicollinearity is a common problem that occurs when the same indicators are applied to one chart, creating misleading signals. Traders can avoid it by applying different types of indicators to a chart, like a stochastic oscillator to indicate momentum or an average directional index to indicate trend. Each indicator provides a different interpretation. An indicator's variables can be altered to produce different results. For example, a simple moving averages result can change drastically when it's adjusted to account for an additional 20 days or more. Optimizing an indicator is an important part of developing an objective strategy for entering and exiting a market.
Again, the main classifications. The first is trend identifiers. Identifying trends over different time frames are useful because it will help weed out all the noise of the daily or the short-term volatility. Any type of trend, including uptrends and downtrends and sideways trends, can be traded for profit so long as it's shown itself to be consistent, or, in my philosophy, non-random. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is moving averages. Moving averages is the simplest of all indicators. Moving averages will help take the noise out of the markets, will help us see an uptrend or a downtrend, and it helps us see what we call red light, green light. When price is above the moving average, you would only buy that asset. So no matter what your filters tell you, you'd only consider a buy. If it's not, your filters aren't telling you to look at a buy, you don't. If it's trading below the moving average, we would only be looking for a short or a sell opportunity. But then we have other trend indicators that include moving average, divergence, and divergence, MACD. We have ADI, we have parabolic SARs, and we have linear regression. There's many different trend indicators. Then, of course, we have one of the most important to me, and that's volume. Volume is the total number of shares or contracts that are traded during a given period of time. When volume comes in really handy is for confirmation. If you applied all of your filters to a trade and you see this buy opportunity, but the market isn't doing anything, the volume is non-existent, or the volume is falling off, means the other traders aren't buying into the scenario or selling into the scenario you're seeing. When prices are rising, we should see, and the trend is secure, or when its prices are falling and the trend is a good trend and the market is sure that, we should see volume at least remaining steady or volume increasing. So there are many different indicators that will tell us how volume is doing, and volume is ultimately important. Then we come to momentum. Momentum is like the speedometer for traders. It shows how fast an asset is moving in a given direction. So if you see price moving up, wouldn't you like to know it's got the momentum and it's skyrocketing? Because what we want to trade is, imagine when you shoot a rocket into the sky or you shoot a firework into the sky, it's going to travel up and up and up, and you're going to wait for it to go up and up and up and up and up. Now, sometime it's going to burst out and we're going to have your fireworks. Well, as it goes up into the air, it's got huge momentum. But at some point, that momentum begins to wane. And you'll see it. It usually arches down and then the firework blasts off. You'd want to know at what point it starts to lose its momentum, or it's starting to lose its momentum. It hasn't turned back to earth yet, but it started to lose its momentum even though it's continuing to go up. Because that's telling you it's getting ready to fall down. And therefore, momentum indicators tell you exactly this. These indicators are typically displayed as oscillators, which fluctuate above and below a baseline, like RSI and stochastics. We refer to them in a lot of cases as overbought and oversold indicators. So arguably the most popular of the momentum indicators is the relative strength index, or RSI. And RSI is represented by a chart that tracks a stock's price on a scale of 0 to 100. Most RSI charts have lines at the 30 and the 70 mark. If the asset moves above the 70, it's considered overbought, meaning that there's too much buying pressure on the asset and it should fall lower. Or conversely, if it's below 30. But we have things like CCI and Chandra's momentum oscillator, Williams percent R. And then another important group of indicators are volatility indicators. It's so important. The Chicago Board of Exchange developed the VIX indicator. We know it around the world as the fear indicator. Okay, it tells us how much volatility is in the markets at the moment. But for us who are trading, CFDs and Forex, we're looking at things like Bollinger Bands or trading envelopes, because what we want to do is see how volatile the market is, because it doesn't matter to us if the market is volatile, but we need to know that so that we can properly place our stop loss, because when the market is volatile, it's got bigger swings in it, and you'd have to place your stop loss at a much lower point. Well, what does that do? When you calculate what the volatility is, figure out where you have to put your stop loss, then your risk management comes in and filters out and say, that's too much risk for you to accept for the possible reward. Can't make that trade. You filtered out that trade and walked away and said, I didn't make it. Okay. Because the worst thing you can do is go back to a trade later and say, oh, look, if I would have done that trade, I would have made this so much money. So I can overlook volatility. No. No. The market offers a billion trading opportunities. There's always other opportunities. Going back and saying I would have, should have, could have is the worst thing you could do. All you want to do is filter out to get the most high probability success trade you can get, and then apply your risk management, because you cannot at any time increase your possibility of risk, because then what happens is you end up wiping out your account, or you have so much loss that when you have a winning trade or a good trade or a solid trade, it doesn't produce enough profit to offset your losings of the bad trades you made. So we start out with trend indicators. These fall into, again, leading and lagging. We have moving averages, okay, the most popular of all these. Okay. It is a lagging indicator. And because we know this is a lagging indicator, so it lags behind the market, we've now introduced, and we have a whole class on it, as becoming very popular, what we call displaced moving average, which you use the same calculation, but you push it forward on your charts. So there's all new kinds of things you can do with different types of indicators. And we move that hedges it from a lagging to over towards a leading, but it still can't lead the stock because it still has to use the average price. Then we have MACD, which is also a very important trend indicator, but it also reveals the strength, the direction, and the momentum, as well as the duration of the trend. And it's a lagging indicator. Now we have parabolic stop and reverse, which is a very complex indicator, but it's one of the few leading indicators. So remember, leading gives trade signals when the trend is about to start, where lagging are those that follow the price action. They give a signal after the trend or the reversal has started. Use them to determine a trend. The most common lagging indicator is the moving average. Now, we go over here to momentum indicators. We have stochastics, CCI, RSI. We've talked about them all, and I'm going to show you these in a presentation. They're also in all of those handouts that I gave you this evening. So as I said, a lot of indicators give you what we call overbought or oversold. And these can fall into an area that's called bounded oscillators. So let's go back over to the chart. And we can see below, and I'm going to use RSI as the example. See how RSI has dropped on the bottom of our chart? And if you look over here, RSI is this purple area, the shaded area, is between 70 and 30. And RSI is always in a field, hold on a second, between 100 and 0. Because no matter what happens in the market, no matter what the open, the high, the low, and the close are, no matter what price action is doing, the mathematical calculation for RSI will always come out bounded between 0 and 100. And we use the standard for RSI, which you can adjust if you want, but the standard we use is anything above 70 up to 100 is overbought, and any calculation below 30 to 0 is oversold. So in other words, it's bounded because it's bounded between 0 and 100, and then it tells us something between the 70 and the 30. Okay. And we have many indicators like this. So I took MACD off the chart. Let's put it back on the chart. Because MACD is an oscillator also, but it's not a bounded oscillator. You see how MACD down below? MACD is based on a center line. At 0. But the first steps of MACD is you're subtracting it's called the MACD signal line from the trigger line, and whatever the difference is, you're plotting on your chart. It could be 1. It could be 1001. It could be 92. It's simply whatever the difference is between the MACD line and the MACD signal line. But it's always plotted above 0 or below 0. Okay, so when one of the lines, the MACD trigger line, is larger than the signal line, and you're subtracting one from the other, it's always going to become a negative number. When the MACD line is bigger than its trigger line, it's always going to be a positive number. So that's why we base it on a 0. When the two lines, so what's called the trigger line and the signal line, are crossing each other, the difference between exactly the same numbers will always be 0. And MACD is based on, one of the parts of MACD is based on when the two lines cross over at the 0 number, it's either generating a buy or a sell signal. But that's an oscillator. It's a technical indicator. That's an oscillator that's placed below your chart, but it's not a bounded oscillator because it's not bounded between anything. It just goes on a center line. So indicators serve 3 broad functions: to alert us, to confirm, and to predict. An indicator can act as an alert to study price action a little bit closely. In other words, an indicator can say, here's a buy or sell alert. Now let's start dropping our filters in. So say if momentum is waning, it may be a signal to watch for a break of support. Or if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. If there's a breakout on the price charts, a corresponding moving average crossover could serve to confirm the breakout. Some investors and traders use indicators to predict the direction of future prices. Now remember, indicators indicate. This may sound straightforward, but sometimes traders ignore the price action of a security and fully focus on the indicator. Technical indicators are meant to be a secondary set of tools. Indicators filter price action with formulas, As such, they are derivatives and not direct reflections of price action. This should be taken in consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about the price action of a security? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining breaks, it could be a completely false signal you're getting from your indicator. So again, indicators are used as filter systems. So as always in technical analysis, learning how to read indicators is more of an art than a science. The same indicator may exhibit different behavioral patterns when applied to different stocks. Indicators may work well for IBM, but not so well for Delta Airlines. Or one indicator might work very well for Delta and not well for IBM. Or they might work extremely well in Forex, but not so well in commodities. And when you start using these and testing these, you'll start to see how each one reacts in different types of environments and for different asset classes. Because you might find that for a slow-moving asset, like a slow-moving stock, it could be a very good buy signal, but it moves slow. It doesn't have that much, it doesn't go up that fast. Perhaps you would make your RSI and change it. You'd still leave the 30-70, but you might only take it as a signal above 80 and below 20. So you have to start applying these once you know the rules and how to use them, and start applying them and using them regularly in your regular setups so that you understand the ins and outs of them. Because there's literally hundreds of indicators in use today, with new indicators being created every week. Technical analysis software programs come with dozens of indicators built in. And even when I showed you the charts on TradingView, you saw there are hundreds and hundreds of indicators, and then you can then personalize the indicators. So there's lots and lots of choices. Even on Alvexo, I think you have 200 different indicators. And even with the introduction of hundreds of new indicators, only a few select really offer a different perspective and are worthy of our attention. Strangely enough, the indicators that usually merit the most attention are those that have been around the longest time and have stood the test of time. So now I'm going to share with you a little presentation on the most popular indicators, show you how they're put on your charts, and then we're going to take a look at combining them together as this filter system to make a trading decision.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Super Trend turning back to red.
So when choosing an indicator to use for analysis, choose carefully and moderately. Attempts to cover more than 5 indicators are usually futile. It is best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For example, it would be redundant to use 2 indicators that are good for showing overbought and oversold levels, such as stochastics and RSI. Now, I don't know why. There's lots of things in the market and lots of systems that people are out there trading telling you to use RSI and stochastics. In fact, they were so popular for so many years that somebody's actually developed RSI stochastics, which is actually one being applied to the other. It's just a bunch of redundancy. So both of these indicators measure momentum and both have overbought and oversold levels. So as we showed you in the little presentation, it's best to find indicators that complement each other, support each other, and give you pieces of information developed in different ways. So that's it for us tonight on technical indicators. Please take advantage of at least the technical indicators guide from investing.com, and also the top technical indicators explanations I gave you, because I broke down everything you just saw in that little presentation and shared it all with you step by step so that you can use it as a reference piece of material after this class is over. So click on those download buttons, download them, because you can't get them at any other time. And thank you once again for coming to our webinar and supporting alvexo.com. And if you want to get more information or you want to get one of these manuals, you can contact Alvexo, www.alvexo.com, or you can get more information by using their free education center. So thank you very much. Have a great trading week, and thank you for supporting Alvexo and investing.com. Good night now.